Inflation is up, mall foot traffic is, down, and traditional retail is supposedly just dying out. I mean, the headlines constantly paint this picture of a consumer base that is completely tapped out.
Oh yeah, completely exhausted, pulling back on all their discretionary spending.
Right, and leaving these legacy brands scrambling just to keep the lights on.
Yeah.
So how on earth did an 85-year-old handbag company just post a 62% jump in earnings?
It really is wild.
It is, and they expanded their profit margins to these staggering levels and somehow acquired 2 million brand new customers in a 90-day window.
It completely defies the gravity of the current economic climate, What we are looking at is a company that has essentially rewired the physics of legacy retail.
Yeah, they aren't just surviving a tough macro environment.
Exactly. They are using it as a backdrop to actually accelerate.
So, welcome to the deep dive. Today, we are taking you straight into the source material of Tapestry's Q3 2026 earnings call.
And look, whether you are an investor hunting for the mechanics of a truly resilient stock or a marketer trying to understand how to actually capture that famously elusive Gen Z demographic.
Or honestly, simply someone who has noticed the undeniable explosion of Coach bags on the street lately, you really need to hear this. We are breaking down the exact blueprint of how a heritage brand stays fiercely relevant.
And, structurally wildly profitable. The term masterclass gets thrown around a lot, but this earnings transcript is exactly that.
Okay, let's unpack this, because traditional retail is supposed to be struggling right now, yet Tapestry just blew the roof off. How do they actually do it?
Well, we are dissecting the compounding benefits of this highly specific, data-driven strategy that Tapestry's management calls Amplify.
Yeah, Amplify strategy.
Yeah. And to truly grasp the scale of what they've achieved, we really have to start with the foundational math they presented.
And the headline numbers alone are just a massive structural flex. I mean, we're looking at pro forma revenue growing 23% in constant currency.
Which is huge.
It is. Earnings per share rocketing up 62% to $1.66. Gross margins hitting like 76.9%.
But, the metric that absolutely jumps off the page for me is the operating margin. It expanded by 490 basis points.
Wait, 490 basis points. So that's almost a full 5% jump.
Exactly. A nearly 5 full percentage point jump in operating margin is virtually unheard of at this scale, especially when you are simultaneously growing your top line revenue by almost a quarter.
Right. Because usually that's a trade-off, isn't it?
Yeah, exactly. To put that in perspective for anyone looking at retail operations, usually you have a binary choice. You can either grow your revenue aggressively, which usually means, sacrificing your margins because you're spending a fortune on customer acquisition.
Slashing prices, running heavy promotions.
Right. Or you can widen your margins by slashing costs, cutting your marketing, and just accepting stagnant growth. But doing both at the exact same time. That's the holy grail of corporate finance.
It really suggests they aren't just getting lucky with a single trendy product. It points to a structural advantage.
Absolutely.
But okay, here's where it gets really interesting to me. The math gets even more complex when you look at their expenses. They achieved this massive profit margin expansion while simultaneously increasing their marketing spend by a massive 50%.
Yeah, that part is wild.
Right. Marketing is now sitting at roughly 12% to 13% of their total revenue. It's like watching a sports car accelerate uphill while towing a heavy boat.
That's a great analogy.
How do you pour almost $1 billion into top-of-funnel brand building, which, is notoriously expensive, and still expand margins that aggressively?
Well, the secret is a concept CFO Scott Rowe broke down regarding operational leverage. They are absolutely pouring money into top-of-funnel marketing, sure, but the conversion rate on that marketing is just incredibly potent.
Meaning it actually translates directly into sales.
Exactly. And not just any sales, it's driving a massive influx of full-price sales. When you sell at full price, your gross margin on every individual item is fully optimized. So as that top-line revenue swells from full-price purchases, your fixed costs, like your corporate overhead, leases, the basic SG&A expenses, they all shrink as a percentage of your total revenue.
So the marketing is fundamentally paying for itself and generating enough surplus to cover the fixed costs even more efficiently.
Precisely. The yield on their marketing spend is completely asymmetric to the industry average right now. I mean, they aren't spending money to offer discounts. They're spending it to build desire.
And when desire is high, people don't wait for a sale. They pay full price.
Right. And that full price selling is the exact mechanism that allows the operating margin to expand even as the marketing budget itself balloons.
Wow. And that engine of desire, the force towing this whole P&L forward is clearly Coach.
Oh, absolutely. Without a doubt.
Because while Tapestry is the parent holding company, Coach is undeniably the golden goose here. I mean, the brand-specific numbers for Coach are staggering.
They really are.
Revenue was up 29% in constant currency. They acquired 2 million new customers in the third quarter alone.
2 million in just one quarter.
It's crazy. And it wasn't isolated to like one hot market. North America was up 27%, Europe up 27%, and Greater China up an incredible 58%.
Yeah, generating that level of synchronized global resonance is, well, it's incredibly difficult. Usually you see a brand get hot in Asia while maybe cooling off in North America or vice versa.
Right, it's rarely a global sweep.
Exactly. But the uniformity of this growth comes back to a very specific positioning strategy that CEO Joanne Crevoiserat and brand president Todd Kahn laid out on the call. They call it expressive luxury.
Expressive luxury. Okay, it's a great phrase for a press release for sure. But I want to understand the actual mechanics of it. What does that mean for you, the person actually walking into a store?
Think of it as the Goldilocks zone of the retail industry. So on one end of the spectrum, you have the legacy European luxury houses.
With super high-end brands.
Right. They are intensely aspirational, but they have priced themselves into the stratosphere over the last few years. I mean, they are fundamentally inaccessible to the vast majority of consumers now.
Yeah, they've priced out normal people entirely.
Exactly. And then on the other end, you have fast fashion and mass market retail, which is accessible, sure, but it completely lacks any aspirational value or lasting quality.
Right.
So Coach has actively positioned itself perfectly in the middle of those two extremes.
They are dominating that, $200 to $500 sweet spot.
Exactly. And under the creative direction of Stuart Vevers, the design language, the hardware, the quality of the leather, it all reads as true luxury. It triggers the exact same emotional response as a bag that costs $3,000.
But because it sits in that $200 to $500 range, it actually remains approachable.
Right. Which leads to a really fascinating economic paradox in these earnings. They reported that their average unit retail, or AUR, grew at a low double-digit rate.
Okay, so wait, let's break that down. They are successfully charging more for their bags.
Yes, but simultaneously, their unit volume, like the actual physical number of bags leaving the shelves, increased by over 20%.
So what does this all mean? In Economics 101, if you raise prices, demand is supposed to drop.
Usually, yes.
But Coach raised prices by double digits and still sold 20% more bags. It's like a restaurant raising its menu prices and watching the line out the door get twice as long. What is driving this irrational emotional demand?
Well, it is the purest metric of brand heat. In behavioral economics, value isn't just about the absolute dollar amount on the tag.
What is it about then?
It's about the perceived gap between the price tag and the status, or like the joy the item actually confers to the buyer. When consumers perceive the cultural value of the brand to be accelerating faster than the price increases, you achieve immense pricing power.
Wow.
And there's a historical context here that Scott Rowe pointed out, which is absolutely crucial. Coach's prices today are roughly where they were 15 years ago.
Wait, really? That is wild to think about.
It really is.
After a decade and a half of global inflation, supply chain shocks, and rising material costs, they're sitting at the same relative price point.
Yeah. And by maintaining that incredible discipline over the last decade, they've preserved this massive runway for growth today. They have tremendous headroom to raise that average unit retail without hitting a ceiling that alienates their core consumer.
Because they aren't dealing with price fatigue from their base.
Exactly. Many brands in that accessible luxury tier tried to chase the European houses by aggressively jacking up prices, and they basically just alienated their base while failing to convince the true high net worth customer.
They got stuck in no man's land.
Right. But Coach stayed in their lane, they elevated the product quality, and now they are reaping the volume rewards.
But, you don't acquire 2 million new customers in a single quarter by selling to the exact same demographic you were selling to 15 years ago.
Oh, definitely not.
To understand this volume explosion, we have to look at who is actually swiping their credit cards. Tapestry is openly stating that their primary point of market entry right now is Gen Z.
Yes, heavily Gen Z.
They are throwing a massive chunk of that billion-dollar marketing budget directly at youth culture.
It is a highly calculated demographic capture. And the strategy they are deploying isn't just a volume play, it is super nuanced.
How so?
Well, Todd Kahn emphasized that they are leading with deep consumer insights, not just product features. They aren't just blasting high-gloss photos of handbags on digital billboards.
Right. The primary example they highlighted was their spring campaign, Explore Your Story.
Oh.
They brought together a really eclectic mix of global ambassadors, right?
Yeah, they had actress Elle Fanning, Storm Reed, college basketball phenomenon Paige Beckers, and K-pop artist Soyeon.
But the underlying brief for the campaign wasn't about status or exclusivity, which is so typical for luxury.
Not at all.
Management noted that the campaign was built entirely around Gen Z's growing desire to turn to books, journaling, and storytelling to find community and a sense of self in a really overwhelming digital landscape.
Which is just a masterful psychological pivot. Traditional luxury marketing is built on the concept of exclusion, right? Like, buy this to prove you're better than everyone else.
Yeah, the velvet rope mentality.
Exactly. But Coach is totally flipping that script for Gen Z. They are positioning the brand as a tool for self-discovery and inclusivity. The core message is, buy this bag to help write your own story.
And for a generation suffering from profound digital fatigue and isolation, offering community and self-expression is a much more potent hook than just offering status.
Spot on. And this feeds directly into what they are calling the Coachonomics flywheel.
Coachonomics, I love that.
Right. If you can establish that deep emotional connection early, the financial payoff is immense. The entire premise revolves around capturing a consumer's very first luxury purchase.
Because that first significant discretionary purchase is a major emotional milestone in a young person's life.
Exactly. By focusing their acquisition strategy on Gen Z, Tapestry is basically intercepting these consumers at the very beginning of their lifetime earning and spending curve.
So if the product holds up and the brand resonance stays strong, the lifetime value, the LTV of that single customer, stretches out for decades.
Yes. But Joanne Kravoiserat brought up a dynamic that I found even more compelling than just locking in young buyers. She talked about reverse influence.
Reverse influence. Okay, explain that.
Well, this is where the strategy moves from just smart to genuinely brilliant. Historically, luxury trends trickled down. The older, wealthier cohorts established what was desirable, and younger demographics aspired to it.
Right. But today, the vector of influence has entirely reversed. Youth culture dictates the broader culture.
Exactly the case here. When Gen Z adopts a heritage brand like Coach, remixes it on TikTok, and gives it contemporary cultural heat, it acts as a massive validating signal to older demographics.
So Tapestry's massive investment in Gen Z marketing isn't just like a siloed youth strategy.
Not at all. It is actively driving broad-based growth across all their older cohorts. The management team explicitly noted strong, broad-based revenue gains with their existing older customer base, too.
The teenagers make it cool again, and suddenly their parents and older siblings feel incredibly validated pulling their vintage bags out of the closet or, going out to buy a new one.
Exactly. The halo effect is real.
But, okay, you're painting a very rosy picture of Gen Z loyalty here, and I have to challenge this premise.
Fair enough.
Because Gen Z is notoriously fickle. They jump from TikTok microtrend to microtrend. Is Tapestry building a billion-dollar foundation on quickstand? Or is there hard evidence in these repeat purchase rates that this loyalty will actually stick as these consumers age?
Look, it is the existential question for any consumer brand right now, and Wall Street analysts hammered them on this exact point during the Q&A portion of the call.
I bet they did.
But the reason management is so confident isn't based on vague social media sentiment. It's based on cold, hard data architecture. Tapestry operates a highly developed direct-to-consumer or DTC-led business.
Meaning they actually own the transaction data. They aren't relying on wholesale department stores to tell them who is buying what.
Exactly. They have a direct line of sight into the customer file. They can definitively track that a 19-year-old who bought a small entry-level canvas bag last year just returned to their website or store this year to purchase a higher-priced leather tote.
Oh, wow. So they have the receipts.
Literally. The data in their file proves that these newly acquired Gen Z consumers actually exhibit higher retention rates and higher repeat purchase rates than the older cohorts.
That is fascinating. So it isn't a fleeting TikTok trend. The data suggests it is a structural demographic capture that is already compounding.
Yep, the numbers back it up completely.
Well, $1 billion in digital ads and hyper-targeted algorithms means absolutely nothing if the physical experience feels like a relic. Let's transition into their physical retail strategy.
Because they are clearly rethinking the entire concept of the store. Physical retail has been pronounced dead a dozen times over the last decade, but Tapestry is deploying significant capital into their brick-and-mortar footprint.
Right. They are currently rolling out their expressive luxury store concept globally. And they mentioned opening new Coach Place stores in critical markets like Japan and North America.
Yeah, but the element that really jumped out to me is their expansion of Coach coffee shops.
Wait, really? Coffee shops?
Yes. They are about to open their 6th one in North America.
I mean, selling flat whites to sell leather goods sounds like a PR gimmick at first glance.
Oh, if you look at it purely as a food and beverage operation, it makes 0 sense. But if you analyze it through the lens of Gen Z psychology, it's a brilliant real estate play.
How so?
Gen Z spends so much of their life in a frictionless digital environment that they actually crave highly tactile, real-world, localized experiences.
Because if they just wanted the physical product, they could order it on their phone in 3 seconds.
Exactly. The physical store can no longer just be a distribution center. It has to be a destination. It has to offer an experience that simply cannot be digitized.
And Todd Kahn gave a fantastic historical comparison during the call that really illustrated this shift. He pointed out that historically, a high-end luxury store might have a craftsmanship bar.
Right, the traditional setup.
You would have an artisan standing behind a counter, and the customer would stand on the other side, waiting for their bag to be monogrammed or repaired. It was a very transactional, hierarchical dynamic.
It was an authority-driven model. You know, the brand is the authority behind the counter, and you are the lucky consumer receiving the service.
Yeah.
But Kahn noted that in their new store concepts, they have literally dismantled the bar. They replaced it with round tables.
Okay, but why does the geometry of the furniture matter so much?
Because it completely subverts the power dynamic.
Yeah.
It shifts the interaction from a transactional service to a collaborative process they call co-creation.
Oh, co-creation.
Yeah. The consumer no longer stands waiting. They pull up a chair and sit with the artisan at the round table. They are collaborating on the customization of the product. They are picking the hardware, the tags, the stamps.
It's like they looked at the Apple Store Genius Bar and said, let's make this fashion.
Huh. Exactly.
But instead of standing at a counter to fix a broken screen, you're sitting at a round table customizing a handbag with an iced latte in hand. It changes it from an errand to an event.
And from a purely operational and financial standpoint, this entirely reimagined environment is engineered to optimize one specific metric: dwell time.
Dwell time.
Right.
Meaning how long they hang around.
Right. If a customer is sitting down to finish a coffee or spending 25 minutes debating which custom tag to put on their bag at a round table, the amount of time they spend inside the 4 walls of the store skyrockets.
And in retail, higher dwell time invariably correlates with higher conversion rates, right?
100%. It means they're vastly more likely to actually make a purchase, and usually with a significantly higher average transaction value. The longer you can keep them comfortable and engaged in the space, the more they will spend.
You're creating an environment they don't want to leave. But of course, the most brilliant store design and the best coffee in the world cannot save a product that nobody wants to wear. The bag itself actually has to deliver.
Absolutely. Because at the core of all this marketing and experiential retail, Tapestry is fundamentally a leather goods manufacturer.
Right. Let's dig into the product innovation and, crucially, the supply chain mastery that actually gets that product into the store, because their product pipeline is clearly resonating.
Yeah, management spent significant time detailing the success across different product families. The Tabby franchise continues to be a massive, enduring standout.
But they also highlighted the launch of the New York family of bags, right?
Yes. Specifically calling out the Brooklyn, the Empire, and the newly launched Chelsea bag.
And they specifically noted that the Chelsea was highly effective at driving Gen Z acquisition, right at that critical $300 entry-level price point.
What's important to note here is the discipline in their design architecture. They are building distinct platforms and franchises, not just throwing 100 random designs against the wall to see what sticks.
All right, they have a clear aesthetic.
When you see a Tabby bag with that signature C hardware, the brand codes are instantly recognizable from 50 feet away. By focusing on these core platforms, they can achieve this clarity of brand vision with far fewer SKUs.
Meaning fewer total distinct items in their inventory.
Exactly, which massively simplifies their manufacturing and inventory management.
And the velocity of demand is incredible. Todd Kahn mentioned a specific pink signature product drop that they modeled to last them through the third and fourth quarters.
Oh, yeah, and it completely sold out in a matter of days.
Days instead of weeks or months. They're also seeing massive acceleration outside of handbags, noting a 20% growth in footwear led by the Soho sneaker family.
The top-line product wins are great, but I mean, the true financial magic is happening on the back end. I want to dissect CFO Scott Rowe's commentary on their supply chain.
Okay, let's hear it.
Because this is where a good quarter becomes a legendary earnings report. If you recall, we discussed that unprecedented 490 basis point expansion in operating margins at the top of the show.
Right, the nearly 5% jump.
Well, if you drill down into their gross margins specifically, they beat their internal expectations by 180 basis points. Half of that massive upside came purely from operational efficiency.
So they managed to significantly lower their AUC, their average unit cost.
Yep. And the other portion was a 70 basis point structural tailwind from divesting the Stuart Weitzman brand, which basically removed a drag on their overall profitability.
Okay, lowering the cost to manufacture a bag makes sense on paper, but wait. Let's connect this to the bigger picture.
The context is what makes this extraordinary.
Because they achieved this gross margin expansion despite taking an absolute beating from global tariffs, right?
A massive beating. Tapestry absorbed a 150 basis point hit on Coach's gross margin and a punishing 440 basis point negative impact on Kate Spade's gross margin, strictly from international tariffs and duties.
Okay, let's just pause and really look at the mechanics of this. They ate a massive geopolitical tariff hit. Explicitly stated they did not raise consumer prices to blindly cover those specific duties, and yet they still expanded their overall profit margins.
Yes.
Because their supply chain is that efficient. That sounds like a magic trick. How do you engineer those kinds of costs out of a high-quality leather bag without the consumer noticing a drop in quality?
It really comes down to what Scott Rowe described as a culture of being makers at heart. This isn't just about squeezing suppliers for cheaper materials, it's deep supply chain engineering.
What does that look like in practice?
It means streamlining the amount of hardware used, optimizing how patterns are cut from a raw leather hide to minimize waste, and, consolidating their sourcing to reduce freight costs. They've built a supply chain that can deliver superior craftsmanship at scale while systematically hunting down and eliminating operational friction.
Wow. But with potential inflation in raw materials like leather or petrochemicals, how sustainable is this efficiency shield looking forward? A European analyst on the call pressed them on this exact threat, right?
Yeah, Rowe was very transparent about the macroeconomic pressures. He acknowledged they are monitoring fuel surcharges, which aren't severely impacting them yet, but represent a modest headwind.
Right.
However, he articulated a massive structural advantage. Because Tapestry is overwhelmingly a leather goods house, they are largely insulated from the extreme volatility we are seeing in petrochemicals and synthetic fabrics.
Which is currently wreaking havoc on the rest of the apparel industry.
Exactly. Their competitive moat isn't just brand heat, it's the physical capability to engineer out costs on the factory floor, protecting their margins without ever compromising the tactile quality of the leather.
It's a phenomenal balancing act. But, while the Coach engine is firing on every conceivable cylinder, Tapestry's other major brand is currently doing the grueling, unglamorous work of rehabilitation.
Ah, yes. Kate Spade.
Let's look at the Kate Spade turnaround. Because the contrast here is stark, but it's vital to understanding the overall corporate strategy.
It is a completely different narrative, but analyzing how management is handling Kate Spade gives investors a really clear view of their operational discipline.
Because the headline numbers for Kate Spade are undeniably tough. Revenue actually declined 11% in the third quarter.
Yeah, it was a rough print on the top line.
But underneath that contraction, there are signs of life. They still acquired 400,000 new customers. And they had significant product wins handbag blockbusters, like the Duo and the Margo outperformed.
And Joanne Kravoiserat shared a fantastic anecdote about a product called the Duo Mini. After it was organically featured on Kendall TV, it completely sold out across both their physical stores and e-commerce channels.
Wait, really? It sold out entirely?
Yep. It was the first time a handbag in that specific segment had sold out in the brand's history.
So the product definitely has the potential to resonate. And remarkably, despite the 11% drop in revenue, the gross margins and profitability for Kate Spade actually exceeded the company's internal plans.
What we are analyzing here is the textbook anatomy of a retail turnaround. This isn't an accidental decline. Tapestry is intentionally, methodically pulling back on promotions and deep discounts at Kate Spade.
Which immediately explains the 11% drop in revenue, right?
Exactly. Retail brands can become horribly addicted to discounting. It drives immediate volume, sure, but it destroys brand equity over time.
Because the consumer gets trained to just wait for a sale.
Right. When management finally decides to rip off the Band-Aid and remove the heavy discounts, you instantly lose the bargain hunters. Your short-term revenue inevitably drops.
But this contraction is absolutely necessary to detoxify the brand.
Yes, and to restore its full price selling power. You cannot build long-term prestige if the consumer is trained to just wait 2 weeks for a 40% off flash sale.
It's like they've put Kate Spade through brand rehab. You have to endure the withdrawals, the immediate drop in sales when you take away the discount drug to get the brand healthy again.
That's a perfect way to describe it.
But Wall Street is famously impatient. Management admitted they expect a modest profit loss for Kate Spade for the full year. How long before a necessary turnaround becomes a major investor liability?
It's a race against the clock, but management is essentially buying that time with the massive cash generation of Coach. Because the parent company is so flush with free cash flow, they have the financial luxury to fix Kate Spade correctly from the foundation up.
Rather than panic discounting just to hit a quarterly revenue target.
Exactly. And they are aggressively monitoring leading indicators to prove the rehab is actually taking hold. They highlighted that their net promoter scores, the ultimate metric for customer satisfaction, are rising.
And they mentioned a new marketing campaign called Spark Something Beautiful. Right?
Yeah, and it's already driving measurable lifts in consideration and purchase intent. And perhaps most importantly, they are doing light touch store renovations that are already yielding higher conversion rates.
They are proving they can fix the plumbing, even if the house looks a little smaller from the street right now.
Spot on.
This ability to absorb a brand turnaround brings us to how Tapestry is navigating the volatile global macro environment. Let's zoom out from the brand-specific stuff.
Yeah, because the regional data from this call provides a fascinating map of global consumer health. The regional divergences really prove that there is no such thing as a monolithic global consumer.
The numbers are all over the map. I mean, Greater China grew an explosive 55%.
Which is massive.
Europe was up 21%. But Japan actually contracted by 10%. And management even addressed the Middle East, noting that despite obvious and severe geopolitical disruptions, it has virtually no material impact on their business.
Right, because it represents less than 1% of their total sales and operates entirely via distributors.
Let's unpack the major moving parts, starting with Japan. A 10% regional decline usually triggers alarm bells, doesn't it?
Usually, yes, but Scott Rowe was adamant that this was planned. Much like the Kate Spade strategy, they executed a deliberate pullback on promotions in Japan to elevate the brand equity and protect long-term pricing power.
Taking the short-term hit for long-term health in a highly sophisticated luxury market. Now look at Europe, up 21%.
Yeah, and Todd Kahn used an interesting phrase to describe their presence there, particularly in France. He called it eye drops.
Eye drops. That's a funny way to put it.
It's a great visual for extremely low market penetration. I mean, Europe is the ancestral home of luxury. The French and Italian heritage houses dominate the landscape.
So for an American brand like Coach to be gaining such rapid, double-digit traction fueled heavily by Gen Z acquisition is a massive validation of their aesthetic.
Absolutely. Kahn highlighted a recent takeover they executed at Selfridges on Oxford Street in London. They featured Rexy, the brand's dinosaur mascot.
A dinosaur at a high-end luxury retailer.
Right. It was a strategic injection of pure, unpretentious fun into a European luxury category that can often feel rigid, intimidating, and overly serious. Because they are starting from such a small base, their runway for compounded growth in Europe is immense.
But the undeniable jaw-dropper of the regional breakdown is Greater China, posting 55% growth.
Oh, without a doubt.
They capitalized on the Lunar New Year, as expected, but they also highlighted a highly specific streetwear collaboration with a Chinese brand called Clot.
This is the ultimate case study in hyperlocalization. You cannot simply copy-paste a successful American marketing campaign into Shanghai and expect it to convert.
Right, the Explore Your Story campaign with Elle Fanning might crush it in New York, but China requires a completely different vocabulary.
The Clot collaboration proves Tapestry understands this. Joanne Kravoiserat explained that they didn't just slap two logos on a canvas bag, they built a fully immersive, multi-dimensional experience.
What'd that include?
The activation integrated video gaming, a branded cafe, a bespoke collection shop, and daily community events. It demonstrates a profound understanding of the modern Chinese consumer, who expects luxury retail to be highly interactive, digitally fluid, and community-driven.
I have to ask the macro question here, though. China is booming at plus 55% for Tapestry, but if you read the financial press, the narrative is entirely focused on China's severe consumer slowdown and economic struggles.
That's a very fair question.
Is Tapestry somehow defying the gravity of the Chinese economy, or is there a nuance here we're missing?
It basically comes down to the mechanics of market share within a massive total addressable market, or TAM. Joanne Crevoiserat hammered this point home during the call. Tapestry currently commands less than 1% of the global market share in their category.
Wait, under 1%? With billions in revenue, they are still just a fraction of the total pie.
Precisely. And because their slice of the pie is so small, the overall size of the pie doesn't dictate their growth. Even if the broader Chinese economy is sluggish or the overall luxury sector contracts by a few points, Tapestry can still post 55% growth simply by executing better than the brand next door and stealing market share.
So they don't need a massive macroeconomic tailwind to grow. They just need their localized playbooks, like the Claude collaboration, to outmaneuver the competition.
Exactly. It is the ultimate advantage of acting like an agile challenger brand, even when you have 85 years of history behind you.
Well, let's bring all of this global maneuvering, product innovation, and margin expansion down to the absolute bottom line. What is this management team actually doing with the mountain of cash they are generating?
This is the section of the call where long-term investors get absolute clarity on the company's philosophy regarding capital allocation.
Tapestry significantly raised their full year 2026 guidance.
They did.
All right.
They are now projecting revenue in the area of $7.95 billion, representing 16% growth in constant currency.
They bumped EPS guidance to around $6.95, which is 35% growth. And their adjusted free cash flow is expected to approach a staggering $1.6 billion.
That $1.6 billion in free cash flow is the engine room of their corporate strategy. And their decision on how to deploy that cash sends a deafening signal of confidence to the market.
What are they doing with it?
They announced they are returning essentially 100% of their expected adjusted free cash flow directly to shareholders.
Every single dollar of free cash is going back. That is a massive commitment.
It translates to $1.3 billion in share repurchases. And they noted they've been aggressively buying back stock at an average price of about $112 further, alongside $300 million in dividend payments.
And they can afford to drain the cash flow precisely because their balance sheet is so fortified. Scott Rowe pointed out that their gross debt to adjusted EBITDA leverage ratio is currently sitting at 1.1 times.
Which is incredibly lean. It is more than a full turn below their stated long-term target of 2.5 times. They're carrying very little debt relative to their earning power,
giving them immense operational flexibility. But the most revealing part of the capital allocation discussion wasn't just where they are putting their money. It was what they explicitly promised they would not spend it on.
You are referring to management's discussion of the four-lens framework regarding M&A or mergers and acquisitions?
Exactly. It is so rare to see this level of restraint. Management stated unequivocally that they will not pursue any new brand acquisitions until two highly specific conditions are met.
Right. Coach must prove its strength is permanent, and Kate Spade must fully return to sustainable top-line growth.
Institutional investors must love that kind of discipline.
Oh, they adore it. The history of retail is an absolute graveyard of companies that generated a little bit of free cash flow, succumbed to hubris, and bought another struggling brand that ended up sinking the entire holding company.
It's like a gambler who gets flush with casino chips after a massive winning streak at the blackjack table.
Perfect analogy.
The temptation is always to take that pile of chips and put it all on a single roulette number with a flashy, risky new acquisition. Instead, Tapestry is literally cashing out the chips and handing the winnings directly back to the shareholders.
Yeah, when a management team buys back $1.3 billion of their own stock, they are effectively telling the market, we have scoured the globe and the single best investment we can make right now is in ourselves.
Is this the ultimate bullish signal for the stock's future?
It is the ultimate display of fiscal discipline for sure. They're currently achieving the ambitious targets they set out during their investor day, a full 2 years ahead of schedule. And they're doing it entirely through organic growth and internal operational excellence, not by papering over cracks with expensive acquisitions.
So bring this entire deep dive full circle. What Tapestry has proven in this Q3 earnings call is that legacy brands are not inherently doomed to age, stagnate, and fade away alongside their original consumers.
Far from it.
The prevailing narrative that traditional retail is a leaky boat taking on water in a digital age is simply not a universal truth.
Tapestry has built a compounding structural advantage by flawlessly blending two distinct disciplines. They have the rigorous, data-driven, supply chain-obsessed operating model, what Joanne Krevoiserat calls the logic.
And they have paired it with supreme creative execution, hyper-localized storytelling, and genuine cultural resonance. The magic.
Exactly. That combination allows them to engineer continuous margin expansion while simultaneously funding the top-of-funnel brand heat that drives volume.
It is an incredible, highly calibrated balancing act. But before we wrap up, I want to leave you, the listener, with a final thread to pull on, something to really chew on as you think about the future of consumer-facing brands.
Oh, I know where you're going with this.
During the rapid-fire Q&A portion of the call, Todd Kahn let slip a passing comment that is genuinely fascinating. He noted that while Gen Z is their absolute undeniable focus right now, they are already looking over the horizon. Gen Alpha is coming next.
The generation born entirely in the 2010s and later. The children of millennials.
Exactly. So here is the provocative thought I want to leave you with. Tapestry has clearly perfected the playbook for acquiring Gen Z.
They figured out that this generation wants to be met in localized physical coffee shops, they want collaborative roundtables, and they want digital campaigns focused on finding community and self-discovery.
Right. But what radical retail experiences will a heritage brand need to invent to capture Gen Alpha? Think about it. We are talking about a generation that has literally never known a single day on Earth without ubiquitous artificial intelligence, hyper-personalized digital realities, and instantaneous algorithm-driven gratification.
It's wild to even conceptualize.
If the smell of coffee in a round table was the disruption that worked for Gen Z, what on earth is the coffee shop of 2032 going to look like when Gen Alpha gets their first credit card?
It's a staggering evolutionary challenge. The psychological X-ray machine of consumer behavior is going to have to be entirely recalibrated once again.
And we will be right here to tear apart the transcripts and analyze the results when it happens. Thank you for joining us on this deep dive into the Tapestry Q3 earnings. Keep digging into those primary sources, keep questioning the default narratives, and we will catch you next time.